Hello, everyone. My name is Kelly Ann Worthington, and today we are going to be talking about credit scores and how they impact your purchase power. So I'm going to go ahead and start the slideshow now. Okay, so one second here. Share the screen. Okay, so welcome. So today, like I said, my name is Kelly Ann Worthington. I'm a senior loan officer with Cross Country Mortgage. And today we're going to be talking about credit scores and how they impact your purchasing options. Get this out of the way here. So, have you ever wondered why, if you have two buyers with similar incomes, that they qualify for completely different mortgage options? The answer is your credit score tells lenders how likely you are to repay borrowed money, and that can be very different between borrower A and borrower B. I've before had two friends that both worked for the same company in the same field, very similar incomes, and they qualified for two different loan types and two different purchase price capabilities. And part of that was due to credit score. So anytime somebody says, well, I know this person and they got this much money and we make the same amount of money, so why can't I buy as much as them? There's multiple different contributing factors to that: income, money that you have available, but your credit score and your credit history are a big indicator and impact on that. So, understanding what a credit score is. So, a credit score is essentially measuring your credit worthiness to be a good borrower of money and be able to repay it back in the appropriate, timely manner without defaulting on your loan that you're borrowing money on. The typical range of credit scores can go as low as 300 all the way up to 850. Higher scores obviously generally mean a lower credit risk, while lower scores mean a higher risk to the lender that's lending the money. So this is a great example of the range of credit scores. So 300 to 579 is considered poor credit. 580 to 669 is fair. 670 to 739 is good. 740 to 799 is very good, and 800 equals excellent. Now, one of the things, if you watched my Zoom training that I did on mortgage rates, just because you have a higher interest rate does not always mean you're going to have the highest credit score does not mean you're going to have the lowest interest rate. There's loan level pricing adjustments. It matters on your down payment, your loan type, etc. But in general speaking, the higher your credit score, the lower your interest rate is going to be, which can then allow you to afford more purchase price capability. So, what impacts credit scores? So, your payment history on your open and previously opened credit is 35% determining factor. Sorry, my nose is itching today. Of your credit score. So, things like, do you have any late payments? Do you have collections? Do you have any current disputes on credit? Have you had a bankruptcy or foreclosure? So, are you on time with your payments? Your payment history is the largest impact of your credit score. The second thing is the amount that you currently owe in debt. So, what your total owed versus what your total allowed to spend is with all of your credit. So, that your utilization of your accounts factors 30%. So somebody who has a $3,000 credit limit that only has $100 on that credit card spent right now is going to have a better impact on their credit than somebody with a $3,000 credit limit that has $2,500 in spending on their card right now. The length of your credit history. This one's really important. A lot of times people will have a card that they've had for forever and they close it out because they're like, well, I just never use it. You don't want to do that. So an unused credit card and an overused credit card can both impact you negatively. So the longer your card has been open, it shows extended credit history of the card never defaulting and you being on time. That helps with 15% of your credit score. So the one thing I always say is you do not have to use your cards all the time, meaning you don't need to rack up debt on them, but go get a pack of gum and then pay it off, or go get a tank of gas and then pay it off. Because the second you spend on the card, they have to report to the bureau that you spent money and that you paid it off. And that can help show that you use your cards and utilize them correctly, pay them down, keep them below the balance. The next factor is your credit mix. So that's a 10% indicator on your credit score factors. So what do we mean by that? Meaning you don't just have a car loan. Maybe you have a car loan and a student loan, or a car loan and a credit card. So having a diverse portfolio of different credit types, showing that you can utilize and effectively pay different types of credit, also can help improve your credit score. And then new inquiries affects your credit score 10%. Now, mortgage inquiries are looked at differently and factored in differently than credit cards and car loans. Credit cards and car loans tend to do multiple, like if you've ever gotten a car, you've seen like 8 different companies pulled for your credit. Those are different than a mortgage. So you are allowed a mortgage inquiry once every 90 days without negative impact to your score. I believe when you do a mortgage inquiry, your score is impacted by 5 points, and 30 days later, as long as no other new inquiries were done, it goes back up. It's kind of like a wash. They know that you have to do a credit inquiry in order to be able to purchase a home. So why credit scores matter? Credit scores factor into determining your loan approval. So whether you're going to get approved or denied, they affect your interest rate that you're going to get. They affect your down payment that you're required to put down. Some borrowers, I've had FHA borrowers, even though you're allowed to go as low as 3.5% down FHA, I've had some borrowers who were required to put down 5%, and they didn't even have a bad credit score. They just had very new credit history, meaning they didn't have anything open more than 2 years on credit. And it looked at their file as more risky because they didn't have a 2-year credit history to see how you've made payments over the past 2 years. So the AUS, which we've talked about in previous videos, the automated underwriting system, determined that their file was too risky and they needed to put down a higher down payment of 5% instead of 3.5 in order to get approved. So that's why how you utilize your credit, how long you've had it opened matters. Also, it'll affect what your mortgage insurance is. Now, with FHA, it's always the normal, 0.55%, but on conventional loans, your mortgage insurance quote that you are going to get is 100% going to be impacted by your credit score. And then your loan type eligibility. If you have a lower credit score, you may only qualify for one loan type, but if you have a higher credit score, you could have multiple options of loan types. So it allows you to have a more wide variety of programs available to you. Also, programs like down payment assistance and grants all have credit score requirements that require typically 600, 620, 650 or above. And so, utilizing and making sure you have a solid credit score is going to allow you to be able to look at more options of programs than if you had a lower credit score. Risk-based lending. So this is how mortgage lenders, who are the ones financing the loans, are determining your risk, is partly by your credit score. Higher scores on credit tend to mean that you have a great payment history, which means you are a lower risk borrower to them giving you money. If you have a lower score, it doesn't mean you're going to default on a loan, but it does mean that the bureaus have determined you're a higher risk borrower. Maybe you have some late payments, maybe you had a bankruptcy, maybe you have some collections, things like that. So that's going to mean you're a higher risk borrower, which is then going to impact your approval, your interest rate, etc. So better scores often lead to lower monthly payments because they're going to allow less down, they're going to allow lower interest rates, lower mortgage insurance costs, etc. The typical minimum score across the board is 620 for conventional loans. So that's the first loan program we're going to talk about. So typically, conventional will never get a pre-approval unless it's 620 or higher. And even at 620, you will get annihilated on your rate. So there is, however, a caveat to this. Fannie Mae in 2025, at the end of 25, just announced that it was eliminating credit score requirement, which is pretty crazy to think about. So it essentially does not have a credit score requirement for Fannie Mae conventional. It just wants to look at your other indicating factors to determine your risk level. So, for example, I recently, right now, have a borrower with a 580 credit score who could have never gone conventional before, and he has 20% down. And they determined through the automated underwriting system and his contributing factors, his job, length of history, the amount of money he was putting down, the amount of money he had left in the bank after the 20% down, et cetera, that they would approve him even though his credit score was 580. But typically, outside of if you have a very large down payment and good work history, 620 or higher is the requirement for conventional for credit scores. Competitive interest rates. So note, the lower your score, the higher your rate, especially with conventional loans. We see it make a difference on VA, FHA, USDA when you have a higher versus lower score, but we see it the most with conventional. So just know, the lower your credit score, the higher your interest rate. Also, there could be points on the rate, et cetera, when you have those higher risk factors of default with your credit score and your loan file. One of the things about conventional that's beneficial is also your lower mortgage insurance costs. So your MI, the higher your score, you're going to have lower mortgage insurance costs. Also, mortgage insurance is able to come off either with 20% down or once you have paid off 20% of the loan if you put less than 20% down. And then it is best typically conventional loans for buyers with strong credit, but just because a buyer has strong credit doesn't mean their file is necessarily super strong. It just means that they typically, because of conventional's credit score requirements, are going to have a higher credit score as a borrower. Now, FHA loans are beneficial typically a lot of times to first-time home buyers or buyers with lower credit scores because they're more flexible with their requirements. So FHA 580 and above will allow up to, as little as 3.5% down. If you are 500 to 579, then it's going to require typically 10% down. They have flexible credit guidelines, which is why they're most beneficial to first-time home buyers, as well as maybe buyers who had some credit issues in the past. And they also tend to have lower interest rates, but they do have that mortgage insurance that stays on there either the life of the loan if you're putting less than 10% down, or for the first 11 years if you're putting 10% down or more. And so they're very popular with first-time home buyers. Now, VA loans, again, you have to be VA eligible for a VA loan. And just if you're in the National Guard or if you're a veteran or an active service member, it doesn't mean you automatically qualify for a VA loan. So you want to contact the VA to find out, are you eligible? If you're active, it's a point statement to determine how long you've been in, how many points you've accrued. If you are retired or separated from service, then your certificate of eligibility confirms if you are approved for, attempting to get a VA loan, et cetera. So it is only for veterans and other veterans and their spouses, or widows of veterans that were approved. So siblings, children, parents, grandparents cannot be on a loan with you if you are not a veteran, an active service member, a spouse of a veteran, or a widow of a deceased veteran that is VA eligible. Nobody else can be on those loans. Now, the benefit to a VA loan is they actually don't have a minimum score requirement. Typically, though, they're going to want to see you above 600. Many lenders will have caveats of 580 or above. The benefit to VA loans, obviously, there's no down payment, so it saves a big chunk of change for the 0% down to give back to our veterans and say thank you for your service. Also, there's no monthly mortgage insurance. There could be a funding fee, or you might be exempt from the funding fee. The certificate of eligibility states that, and they allow more flexible underwriting. So there's no official debt to income ratio maximums like there are with FHA, conventional, and USDA. So it's a great program for veterans and active service members. USDA loans typically are always going to want 640 or higher. You can sometimes get away with what's called a manual underwrite below 640, but it is very hard to do so. So typically just go off 640 or higher for USDA. USDA benefits are that it's a 0% down loan. So again, there's no mortgage insurance. There is a USDA fee in the loan and in the payment, but there is no mortgage insurance, zero down payment. The difficulties are that it's property specific. mostly in rural and suburban areas, not in cities or urban areas. It's specific to the address on if it's USDA eligible. And also they have income limitations. So you have to count incomes of all adults that are in the property that are currently working, even if they're not on the loan, in regard to, are you allowed to qualify and utilize a USDA program? Jumbo loans are for higher purchase prices above the standard conventional conforming loan limit. So each loan type has a maximum loan amount that it can host. Jumbo loans are for when you go above the conventional maximum. They typically require 700 to 740 or above credit scores. They're used for higher priced homes. You need to have strong credit. Reserves are often and almost always required. Due to the larger loan size, there is a higher risk, which means it does come with higher interest rates, even if you have a great score. And it does typically require a large reserve requirement to make sure you're not going to default on that mortgage after you get this large loan. Credit scores and interest rates. So higher credit scores can help borrowers, like we talked about a little bit earlier, secure lower interest rates. Lower interest rates are going to reduce your monthly payments, and they're going to increase your buying power because they decrease your debt to income ratio. So that's kind of how they are all factored in together. So I wanted to give you an example comparison for payments. So let's say you are purchasing a $300,000 home. You're a first-time home buyer. You're putting 3% down. It's a conventional loan. Now, these scores and rates are not, this isn't like a real thing. This is just a kind of example of kind of how they shift and adjust based on score. So let's say you have a 760 credit score. Your example rate is 6.75. Your principal and interest payment is going to be $1,887. Now, if you're sitting there, same file, but you're at a 680 credit score, your rate might be 7%, which then your payment of your principal and interest goes to $1,936. And if you're at a 620 credit score, the bare bone minimum for a conventional, unless you're going Fannie Mae with that caveat, then you're looking at maybe, for example, compared to these 7.375, where your principal and interest payment is $2,009. So a 760 borrower versus a 620 borrower, you see that difference of how it can affect you payment wise on what's coming out of your pocket on a monthly basis. Impact on affordability. So lower scores lead to higher monthly payments, reduced purchasing power, and higher cash needed sometimes at closing. Mortgage insurance impact with lower scores are lower scores tend to increase your amount of monthly mortgage insurance. The benefit is FHA, it does not. Conventional, it 100% will. And there are some risk-based pricing adjustments based on your credit score with mortgage insurance for conventional as well. The thing to also remember, though, it's not a doom and gloom. Just because you have a lower credit score doesn't mean you shouldn't buy a home. It just means that you need to be aware that when you're seeing rates online, those, number one, are not realistic rates. They are like the end all be all perfect buyer scenario, no debt, $100,000 extra in the bank, job history, that's perfection. Your score is going to be based on your personal file. And so that's important to understand, is that simply you need to understand you might not be getting what you're seeing online. It doesn't mean you shouldn't buy. You just have to be aware that it could mean that your payment is going to be slightly higher than somebody else who has a higher credit score. So let's talk about how you improve your credit. So always pay your bills on time. I know this is an obvious one, but it still goes without saying. Also, the important thing is I have so many borrowers who, when I see late payments on their credit history, they were like, well, I was late on the payment, so I just figured that I would wait until the next payment was due, and that's when I would come in and make my next payment to save a little bit of money. Don't ever, ever, ever do that. Even if you're a few days late on your payment, still get your payment in, because what happens is, as long as you haven't hit that 30-day mark yet, outside of February, obviously, and the next bill hasn't generated and you get that payment in, they're not going to report it late to the bureau. The second they generate that next statement and you haven't gotten your payment in for that month, they immediately are required by law to report it to the bureaus, and that can stay on your credit report for over 7 years. And the late payment history, like we talked about the percentage of that, right? I believe it was like 30%, massively impacts your credit score when you have a late payment go on credit. It is not worth it. Even if you're a few days late, get the payment in, make the payment, but always try to be on time with your payments. Lower credit card balances. Just because you're allowed to spend 2,000 doesn't mean spend 2,000, or you can spend it but then get the payment made so that you are under 20% of your available allotment that you're allowed to spend before those bills get generated. Having under They would love 10% or less, but under 20 is good. So always try to keep your open revolving credit cards, your installment agreements, which is what those are. Always keep revolving, not installment. So on credit cards, they're revolving. Sorry, installments are like car loans, student loans where you have a set payment. Credit card bills are revolving credit. You always want to keep those under 20% so that you are getting your score improving each month, showing that you're not overspending just because you have the available credit. This one we talk about all the time. Please, 12 months before buying a home, if at all possible, do not open up any new credit. Don't open up new cars, credit cards, especially do not get a car loan, etc. If you talk to a lender and your lender is working with you on building your credit, sometimes they will have you open based on what the credit bureaus are stating, what's called like a secured credit card or things like that. That's different, but wait for their guidance on it. Don't just do it to do it. And we'll get into this about talking to lenders, but try to avoid at all costs opening up new debt within 6 months to 12 months before purchasing a home, especially with cars. If you know you're going to need to get a car and you're thinking about buying a home, get the home first, get the car later, if at all possible. Keep old accounts open. Like we discussed, the longer the card is open, the better it looks for your credit. Also, don't just let it sit there and not spend on it because that can hurt you. So try to buy one thing a month just to show utilization of the card, pay it off, you're fine. But the longer a card stays open, the longer your credit history is, which helps improve your credit score. And then finally, review your credit. Be aware of what's on there, whether it's through the lock safe programs where your credit's locked, to make sure nobody can add stuff on there in your own name, or whether it's that you go once a year to get your free credit report online, to make sure that there's nothing showing on there that isn't accurate. However, if something isn't accurate, you can file a dispute with the bureaus, but be real with yourself. And we're going to have a little CTJ here for a second. Be real with yourself. If you know that you were late and it went to collections, whether you think it's fair or not, if it was your bill and it was late, don't dispute it. Pay it, set up a payment plan, get it out of collections. When you dispute something, it stops affecting your credit score. So that's why people do it. They go, well, I dispute this isn't accurate, right? So if it's not accurate, that's fine and you can dispute it. However, it's important to understand there are very, very big rules with disputes when you're going to get a home loan. Your disputes need to be removed or resolved. Get them off of there, because if you have more, so certain loan types don't even allow disputes on derogatory items, and other loans, if you're above $1,000 in total disputed items, the disputes have to be removed, and then they have to reevaluate your credit score. Because when you remove that dispute, it starts factoring back into your credit again, which can change your score. So always try within 6 months before getting a home loan where you're wanting to buy, make sure any disputes that you're disputing on credit are removed so that your credit gets adjusted accordingly and you have real numbers going to purchase a home. Because I've seen that bite people in the butt when they try to dispute everything on credit and then they have to remove it and then it impacts them and then they can't buy a home. So try to manage that stuff. When it happens, get it resolved, get the dispute removed. Work with the loan officer early. So this is something I can't stress enough. So often, and this message is more for realtors. So often I hear realtors go, well, I just tell them to go get a pre-approval to start. And then after they get an accepted offer to then go shop around for a lender. One, technically, liability wise, you put an offer in with a letter. If you change the lender, it gives the seller a loophole to be able to get out of the transaction. Don't do that to your buyer. Number two, the other thing that I will just state to realtors is you're out there working for free every single day as you show clients homes, look up homes for them, take them to homes. Your lender is doing the same thing. They're spending hours reviewing documents. They don't get paid by the hour. They are a commission-based job. They are cleaning the file, preparing documents, spending the time doing the work. So if you want to tell buyers to check out different lenders, that is totally okay. But they should do that before getting a pre-approval. That is when they shop, is at the pre-approval stage. So they go, they get a pre-approval, request the number estimate from each lender, and then they go look at homes. Because whatever those lenders are quoting as rates, obviously they might be different 3 months down the road, but they're all going to be the same amount of difference 3 months down the road as a lender. So if you're sitting there talking with your clients, telling them to go shop lenders, do it at the beginning. Don't have a lender sit there and do tons of work for a client and then have them go shop afterwards. Again, it's a risk to the buyer with them changing lenders on a seller, but also it's just not kind to do. It would be like a lender, once you get an accepted offer and sending them a purchase agreement, going in and being like, hey, I know you've been with this realtor, but I can find somebody who might take a little bit less commission. You don't want them doing that to you. Don't do it to them. It's okay to go interview different realtors. It's okay to interview different lenders, but you want to do that when you're getting pre-approved and before you've gone to see homes. That's when you do the interviews. Call them, find out their availability, make sure that they are a personality type that you feel comfortable working with. Look up their reviews, make sure that the reviews are there and that you can find them, right? So that's just my little moment to express that. But the reason that I say this also is because one of the things so many people do wrong is that they wait until they have to buy to go talk to a lender. You want to prepare to buy. And what I mean by that, it doesn't mean you have to necessarily fill out a pre-approval application, but you want to talk to a lender and be like, hey, I'm thinking about buying in 6 months to a year. I just want to make sure I have my ducks in a row for what I want to do. The lender can talk to you about what's your estimated credit score. Let's look at your 2-year work history. Let's talk about your current job. Is the income usable or do you need more time with it? What's your credit history like on your payments? Are there any bankruptcies or foreclosures? What kind of money do you have saved up? What's the purchase price you're looking at versus how much you would need to be able to purchase? Are you comfortable with those payments? Those are all questions that you can have general answers to. They might not be honed into the exact thing as seen in an application, but talking to a lender ahead of time and then determining, do you need some help with credit? In that case, we can do an application. If we know you're not ready, we could do a 1 bureau soft check on your credit, access our credit profiles to let you know what you need to do to work on for your credit to let you prepare. So being prepared and working on that ahead of time can be so positively impactful for your purchase price capability, for your interest rate, for your experience buying a home, etc. So definitely, and not all lenders want to work with clients ahead of time. I love doing it because I'm all about the client. So you can reach out to me, obviously, anytime. But if they're a good lender, they should want to work with you ahead of time to help you prepare to buy. So in conclusion, credit scores affect loan qualification on if you can get approved or not. Better scores are going to increase your affordability because lower interest rates mean lower debt to incomes, which mean higher purchase price capability. Higher credit scores also mean you're going to be able to utilize the lowest down payment amount possible. Different loan types have different requirements, so be aware of that. Just because you want conventional doesn't mean you might be able to go conventional, or if you want USDA, you might not be able to go USDA. So that's why talking to a lender ahead of time to prepare for that is really important. And again, prepare so that you can have a positive experience. So thank you so much for joining me today. I greatly appreciate it. My contact information is on the screen. I am available 7 days a week, 8 a.m. to 10 p.m. My QR code for my online virtual business card with all of my links is there for you to take a photo with, to get it linked and reach out anytime. I hope you found this information helpful, and thank you so much for attending. Bye, you guys.